Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started.
A big aloha and welcome to episode 22, the relationship between risk reduction and valuation and multiples. I'm coming to you live today from Kaneohe, Oahu, one of my favorite places on earth. And I want to start with this belief, this thought, this idea for you that multiples are just risk shorthand. When buyers quote a multiple, what they're really telling you is, hey, here is my confidence score that the earnings and continuity of the business is what you're saying it is when you hand it off. And if you take a look at it as a confidence score, you'll view your actions that you need to take in the years coming that you're going to get to prepare to sell your business. So price equal to earnings times the multiple, and the multiple expands when perceived risk shrinks. You want to reduce the risk as much as possible. So owners chase earnings, sophisticated sellers chase multiple expansion levers. You want to take a look at the inside of your business and say, if we divide this up by department, there's probably 10 things that we can do in this quarter to fix and get this business on track. And you're going to pick the highest and best use of your time with the least amount of risk. Everything you should do from here on out is all about risk reduction for the buyer. At some point, there's going to be a private equity company, a private investor, or a group of investors that come in, and they're going to ask a lot of questions, and they're going to want to see the books, and they're going to want to see data and information and maps and job descriptions and standard operating procedures. And the sad thing is there's a lot of companies that don't put these items in place, and then what ends up happening is somebody comes in and buys them. And then for the next 6 and 12 months, they put everything in place and they right-size the company. They get the right people in place and they walk away happy because they bought you for a discount. You may ask, hey, Scott, why does risk compress price? Because at the end of the day, the buyers, whoever it may be, the group, the individual, they have to protect their downside. And every bit of uncertainty is a ding or a dent against you when it comes to the valuation of your organization. And so they're either going to give you a less valuation in the beginning. So your company should be getting $5 million, but they come in, they say, hey, there's too much risk. We'll give you 4. Or what they do is they go, yeah, we'll give you 5 million, but there's a ton of conditions. There's a ton of strings and rules associated with this. And it's going to come down to employees and cancellations and services that are provided and chargebacks. What you want is the easiest sell possible, where you walk in on one day, you turn over your keys, you turn over your security codes, you turn over whatever needs to be done, the codes to get into the CRM, to the computers. And the cleanest thing for you to do is walk away, but that takes preparation. That takes time. Most people don't realize that that could be 5, 4, 3, 2 years into the future before this decision is made even to sell. You want to think about like this purchase from the other side. Are they buying a fix and flip? Are they buying a home ready to go? Those are 2 different prices. You know, in a real estate market, if a house has a value of $750,000, and that's a normal house on the market, but if it needs a roof, that could be 30, 40, 50 grand. If it needs a new heating and air system, depending upon where you live in the country, that could be $10, $15, $20,000. If it needs landscaping, you know, when somebody goes and says, hey, I'm going to buy this home, if they're going to put in the sweat equity, they're going to get a discount. The same thing happens when you go to private equity or an investor, unless they really want to buy your company, your product, your service, your office for a very specific reason or a region that's going to allow them to move faster. You want to have a quality of earnings, and there are volatility penalties. This means that if you have erratic revenue or margins, the buyer goes into like, this is the worst case scenario. And so you want to start measuring revenue volatility, your monthly variance, and set up a target to reduce it. You want to make sure that you're renewing contracts, that your pipeline inside of your sales department is clean, and that you have some sort of pricing discipline. That one of the mistakes that I see people make is they know that they're selling, and they will sell anything and everything so that they can prove revenue in the trailing 12 months. But a smart investor is wise to that. There is a feel to a good story. There's also a feel to a bad story because there's energy associated with it. And there's been deals that I've been on where somebody tells a story and I'm like, this just doesn't feel right. And it's the gut check. And a lot of times when it doesn't feel right, and I'm not going to say every time, but a lot of times when it doesn't feel right, there is a problem because there's tonality involved. There's problems with the story. I'm in a deal right now where the seller is playing games. And my team on the other side is sitting there going, these are all the normal games. And the seller doesn't think that we know what's going on. But I'm going to share with you, when you do enough deals and you see enough deals, what you're going to find is it's highly visible. If you're an expert in your industry and you hear something, you're like, that just doesn't sound right. Or, yeah, I've heard that excuse before. That's not really the excuse. That's not really the problem that you're facing. You want to be aware that at the end of the day, when it comes down to it, you don't want those problems. You want to be able to walk away and say, free and clear, here, can you just give me my money and I'm going to turn over a great company to you. You want stable leadership, and a strong second layer of leadership is key man risk. And key man risk, once that's reduced, it allows for you to ask for the higher multiple. It doesn't mean you're going to get it, but it also prepares you for somebody to walk away. Good leadership is acquired all the time. It's not uncommon to get solicitations in a management role, especially if you're good at what you do. So if your number one or number two leader quit today and they walked out, would you say, hey, we got the depth of the bench to take care of this? Or would you be saying we're in a world of hurt? And if you're saying, hey, Scott, I'd be in a world of hurt, then what you really want to consider is what could be done right now today for you to reduce that risk. Could you delegate some of the roles and responsibilities? Could you get the manager, the operations, whoever it may be, to give some SOPs? I know of an organization where the salesperson that had been there for a long time just walked in and quit. There was nothing for the team to go off of. They had no idea. There was no standardization, so it took an entire month and a half to get everything back up and running. And if there would have been playbooks, if there would have been standard operating procedures for somebody to work from, it cuts the learning time down. So you can have an operator or manager come in and they can work at a certain level of capacity and be good, but why wouldn't you make it easier for them? Why wouldn't you standardize as much as you can inside of your organization? Predictability gives you a premium, and predictable businesses attract more buyers when it's time to sell. They get better financing. There's probably a pool of money. Private equity goes out and does money raises. And then there's Excel Eddie that's sitting in there and saying, hey, here's the actuaries that we're taking a look at, and we project that we can make this much money by buying this much company into the future, and we'll give you a certain amount of multiples for it. So the more that you can lift your multiple, the more that you can get that maximum multiple, the better off you are. And if you win, I should say, when you build predictability with reoccurring revenue, consistent delivery to clients, and forecasting accuracy, it improves quarter over quarter. What you focus on grows.
A message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going.
Buyers look at an investment like a risk-adjusted return. They're not just buying your upside story, they're buying your history. They're buying all the documentation that you have in the past to prove your thesis. And every unknown makes the return look less attractive. And you're probably going to get worse terms or a price drop, or maybe even both. You want this history to be available for them to see. You want to be able to open the books and say, here's what's going on. They sign the NDA, they sign the agreement, and you're like, I've got all the proof that you need. And it allows for you for a better negotiation. It allows for you get to walk away from buyers. Like at the end of the day, the thing that you're looking for that nobody tells you is for you to be able to tell somebody no, right? Like I don't think your offer is good enough. You want to be able to do that. Now, there are some people out there that are out of their minds. They are absolutely out of their minds that they think that they deserve a 10 multiple and they're a 3 multiple company. And then there's times where you take a look at an organization and a company and it's a 5-time multiple is what it could be. But you open the hood and you look underneath and you're like, this thing's a race machine. This thing's got some horsepower to it. We could give you a 7. And that's what you want. You want that maximum multiple. You want to get as much money on that exit as you can. So there are some expansion levers that are going to work to your favor. And one of those is to reduce client concentration. And so if any one company, individual, service takes up 20% of your revenue, that's a sign like, hey, we need to diversify. If it's 30, 40, or 50, you're in trouble. And you're going to end up with holdbacks and you're going to end up with all sorts of conditions on the sale. You want clean financials, like just clean financials for any organization really work to your favor. And you want to have a closing date on those. You want stable leadership. You want reliable reporting cadence. All the boring levers that I'm talking about here give you the premium multiple. They give you, you're buying yourself more money is really what it comes down to. And you want to take we'll just figure it out later. And the way that you do that is through standard operating procedures, KPIs, ownership of bands of management, meaning that this is your role and responsibility. It's a defined role and responsibility. You want weekly operating rhythms. You want meetings. You want a standardized onboarding process, excuse me. And you want a training path. So what we're talking about here is risk reduction. You want to reduce the risk every step that you have so that the buyer takes a look and they go, hey, this is everything that I'm looking for. When private equity comes in to buy a company and they see uncertainty, they protect themselves with contingencies, longer due diligence, more reps and warranties, escrow-based performance payouts. Reducing risk means terms. And even when the price stays flat, if you have a $5 million company and they add terms, you may only end up walking away with $3.5 million or $3 million. So all the work and the effort that you put in now really benefits the multiple that you're going to get on the way out. I'm going to give you a very straightforward formula that's owner friendly and simplified so that it makes more sense than ever. If you can reduce the risk down, it increases the confidence up of the buyer, which is going to give you more competition in the marketplace for people to make the purchase, and it's going to give you a better multiple. And every credible buyer that comes to you and wants to make the investment inside of your organization gives you better leverage. Either you're going to work for this leverage now or somebody's just going to walk away with it, and that's not what you want. There's some common misconceptions when it comes to you selling your business. And one of them that I hear a lot is, well, if we grow faster, the multiple will rise. Fast growth can actually lower multiples if it introduces churn, complexity, founder dependency that a new buyer, a new operator can't underwrite. At one point, I was really into automobiles and painting cars and doing all sorts of restorations. And I remember going to the body shop, and I worked in the evenings in a body shop just so that I could learn how to paint. And I was talking to one of the painters early on, and we were talking about what it takes to prep a car. And he said, Scott, everybody wants to shoot the paint, which means to paint the car. Everybody wants to paint the car. But it's all the hours of work that you put in up front that the paint can't hide. If the body work is not good, the paint will just amplify it. And so sometimes a company, an organization, a business is the same way. You may rush the body work, so to speak, on the organization, on the company, but the paint is going to come out horrible. And somebody who's been in the industry long enough is going to be able to point that out and say, hey, there's problems here. There's issues here. So your role, your responsibility is to go through your organization and take a look at it objectively and say, hey, what are the top 5 risks that a buyer would have? Whether it's dependency upon me as the owner, whether it's concentration risk of a client or a product that's being sold, whether it's volatility with employees, if it's weak reporting, it's undocumented processes and procedures. You want to make this list and say, hey, we got a couple of ways we can do this. We can go for fast and easy, or we can go for the maximum lift and multiple. And this is strategic. I would say take some time. This isn't something that you're like, hey, I'm driving my car right now. I think I'm going to pick option A. Really strategize and say which one is going to give me the most amount of lift for not just my exit, but my team for today, which is what's going to build the most inroads to get my team excited about doing all this implementation they're going to need to do. I'm going to share with you, if you're at that 2.5 sub $3 million mark, these are all the changes that you absolutely positively have to get above 3. I see a lot of founders and owners get completely frustrated and they'll say, Scott, I've been trying for years to get my company above a $2 or $3 million revenue, and I just can't do it. And I have to point out, it's because you don't have standard operating procedures, you don't have org charts, you don't have job descriptions, you don't have meeting cadence. You're not going through and taking a look at this organization and running it. You can absolutely get a company up to $2 or $3 million, and then you hit a level where it's like the playbook changes, and this is the playbook. Your job is to systematically work on a higher multiple that you're going to get, AKA buy a multiple every quarter. And this happens by you reducing uncertainty. So if you're asking every week to your team, to yourself, what's one risk that if we remove this would make business easier? And by default, if you remove that risk to make business easier and more automatic, it automatically raises what you're going to get and makes it feel safe for your buyer.
Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.